Thank you for checking out this video from NetPicks. And today, let's talk about choppy markets. We're going to talk about how to find them, and we're going to see if they can actually be useful instead of traders just ignoring them. And just a little note here, 80% people watching this are not subscribed to our channel. So if you like the content that we're always putting out, please hit that button down below. So with choppy markets, a lot of traders just want to avoid trading them for pretty good reasons. Oftentimes the market condition of a choppy market, it gives no indication of who has the upper hand in a price imbalance. So having a way to identify choppy price action can actually help traders avoid placing trades when there's really no edge in placing one. Okay, but let's also consider that this type of condition is not useless, because from choppy price action, we will eventually return to price that we can actually trade. So let me say this right from the start, that this type of observation can be pretty subjective, right? Each trader is going to see something a little different on the chart, okay? But that's not always a bad thing, because this actually makes trading more accessible to anybody that has the capital and will spend the time to dedicate themselves to becoming a trader. So what is choppy price action? Okay, now this type of price action, we don't want to mistake it for properly forming a rectangle pattern, for example. Rectangles are going to often provide trading opportunities between support and resistance levels that you can easily identify. So looking at this chart here, we can see identifiable areas of support and resistance that can equal trading opportunities. Now looking at this chart, now we can see the movements of price, they're not as clean, right? Support and resistance zones, they're diagonal. We have momentum candles interspersed with smaller range candles. That bigger upper shadow, that's not very helpful to trading. So this chart would actually make some painful trading for a lot of traders. And just skipping this type of price action is probably not a bad idea. Guys, the price action seems to be randomly moving, right? There's not any clear sign of who's in control. So let's stop right now. Let's just cover what we just talked about. You now know that if you can identify market structure, support and resistance zones, there is an opportunity to place trades around those levels, right? You're going to need some type of range trading strategy to ensure that you follow some type of plan when you're tackling this kind of market though, okay? So let's talk about identifying choppy price action. So if you're a day trader or you prefer swing trading, it doesn't matter. Finding price action that's not suitable for trading is pretty important, right? It can keep you out of looking for trading opportunities that have very little chance of success. And really, one of the easiest ways to find price that's choppy, just use a moving average. Since a moving average is generally just using the closing prices, as the closing prices have less of a range between each other, price is eventually just going to whip around the moving average. So length of the average is going to matter. Okay, this example here, this is just a 20-period simple moving average. It's a daily chart. So on the left, we see an obvious uptrend. It's in place, right? You get some brief consolidation periods that can give an entry into the up move. Now the red lines, they're showing areas where price is staying pretty close to the average price of the last 20 days. So due to the lack of range between each closing price, the moving average will eventually catch up to an area around the majority of price action. So the difference between trending price on the left and the choppy action in the middle and on the right, it's pretty obvious to look at. You can see it. Now, if I use a longer period, like a 100-period SMA, we will still get an indication of a choppy market, but it's just going to happen a little bit later than the 20 SMA. So if you're using a longer-term average, right, traders may find trading opportunities in the middle of this chart before the objective indication of a choppy market is seen on the right. I cannot give you the best moving average to use, okay? It's going to depend on your trading style, but you should try a few different settings just to see which one matches your eyes better. It's also going to depend a lot on your skill of reading price and just understanding the story unfolding on the chart in front of you. We can also use price action. So a trending structure is just a series of higher highs, higher lows, or lower highs and lower lows. But once we see price failing to show that pattern, that's when we can start to consider the possibility that we're entering a different trading environment. So in this highlighted area on this chart, we start to see the trending pattern break down, and that could put us on alert that the instrument may not be a good trading candidate. Now, a trending pattern will change during the transition of trend direction, but for a choppy environment, we are looking for price to be contained within price swing levels for a longer period of time. That chart's a really good lesson, right? Because what some traders may think of as choppy, others may see an opportunity that's presented here. Let's talk about that. So what could look like a choppy condition, right, that has a high risk potential could actually be a setup waiting to form. So at this chart here, after price makes a big move in one direction, price will often consolidate which can often look just like a mess of price action. Now, if you had time to watch the video about chart patterns, you're going to see that this chart here presents an opportunity. So price had made almost a 50% jump in price over a 2-week period. Now, this pattern can be called a triangle pattern of sorts, but I just use the term consolidation, right? Because understanding the imbalance and what's going on, that's more important than the name of it. Here's the thing. It's also a complex correction into the lower trend line. So given the strong move in price and then the consolidation, what some would consider choppy, eventually turns into a tradable pattern. Now, even if you didn't catch the pattern, if you just use what you're seeing as information, the price is tightening, as it often does before a breakout. That would then set you up for the breakout pullback trade on the right, the bopd. Now, not all chop is going to be the same. Okay, you're going to have to train your eye to be able to look at a chart and determine if that chop that's present is even worth exploring. So this chart stands out to me as one that I would not even bother to entertain for a trade. So not only is it objectively, it's whipping around the moving average, we can actually see momentum pushes mixed with small range candles on both the buyer and the seller part. So high volatility mixed with low volatility in such a back and forth manner, that is a really tough trading environment. So every market participant, you're going to have to be able to learn what is good chop and what's bad chop. Okay, it's not always black and white, no matter how many videos or blog posts say it is. All traders, you included, should spend some time looking at instruments that have made a strong move in one direction, that have consolidated, and then had another leg in the same direction. Right? You're going to have to do your homework. Find similarities that you can apply to your own trading. Now, is there a certain time frame to look at? Look, there's no need to complicate things. So if you take trades off the daily chart, use the daily chart to determine the trading conditions. Right? If you start to use different time frames, then you run into the issue of chop on one time frame actually being a trend on another. So this is a 1-hour chart of the chart that we've been looking at. That's not overly pretty to look at. There are times when mean reversion sets in and then it sets up a trade. There are small consolidations and breakouts that hit at least 1-hour price targets. So the bottom line is what matters most is your trading setup that occur on your own time frame, the trading time frame, right? So keep your focus on that time frame. That makes sense, because you're going to get conflicting information the more periods you look at, and that's tough, especially for a newer trader. Now, eventually, a choppy market's going to break out into a trend trading environment. Sometimes after a long period of consolidation, the runs in the trend can actually be enormous. And now breakouts on momentum can work if you can position prior to a potential break of the extreme high or low of the, quote, choppy price action. It can actually yield some great trades. So the kicker is that eventually, you're going to find some information that points to one side, buyers or sellers, they're taking the lead. Okay, you're not always going to find it. And like the daily chart in the last example, those breakouts will more likely fail. This chart here, using the moving average chop determination method, it gives us a sign that the imbalance is actually favoring the buyers. See, not only do we have a spike at support, we can actually start to see higher lows holding against resistance. So if you're using a scan that had like closing prices being a percentage near a moving average, you're going to find a list of stocks, some crypto, or even future markets to dig into. So from your chop scan, if you see a pattern like this chart or any number of chart patterns, you would also have a potential trade setting up. Now, if you're unable to determine any pattern or price action just appeared random, you just skip the chart. Now, the fact that price was holding near resistance, it no longer makes this a choppy market, but it's one where there seems to be an edge in a potential buy. So moving forward, finding a market that could be in chop is as simple as looking at a moving average or just look at a lack of trending price structure. Right? We don't need a ton of indicators or time frames to determine that market state. You should be able to look at a chart and just say, yep, that's chop. The point is, choppy trading conditions do not have to automatically be ignored. We get a strong trending run in price. You may eventually see a chart pattern that shows an actual imbalance of buyers and sellers. This will give you an opportunity for a trade. You may also find a choppy market turns into identifiable support and resistance zones where trading can occur. You will eventually, I think, be able to quickly look at price and determine if it's simply random price action or is there an obvious imbalance taking shape. If you see that, you may actually look to find an entry price prior to the actual breakout of the extremes, and you might even just catch a massive run in price. Can it be done? Absolutely. Thanks for watching. Make sure you hit subscribe. Any questions, comments, put them below. Like this video. We'll talk to you soon.